Okay, imagine a gold rush, but instead of gold, everyone's scrambling for computational power. The AI revolution is creating this, well, insane demand for data centers bigger, faster, more powerful.
Right, the infrastructure to support it all.
Exactly. And there's this company, Applied Digital Corporation, ticker APLD, kind of right in the middle of it,
Yeah.
with a pretty dramatic story. They've just announced a massive multi-billion-dollar deal that sent their stock surging.
Yeah, huge jump.
But they also have this history of significant losses, and they face equally massive risks. It's quite the contrast.
It really is. What's fascinating here is how that enormous market opportunity meets the very real, intense challenges this company has to overcome to actually capitalize on it.
Yeah.
It's not just about the vision, right? It's the gritty details of execution.
Absolutely. And that tension, that's exactly what we're diving into today. Welcome to a deep dive into the source material surrounding Applied Digital Corporation, APLD. Our mission, like always, is to pull out the most important knowledge and insights from the sources you shared with us.
To help you get up to speed quickly and thoroughly.
We've looked at financial reports, news, analyst notes, even some critical short seller reports. It's definitely a complex picture.
Yeah, you really need to look at it from all angles.
And speaking of getting informed, just a quick note. This deep dive, like quite a few we do, was actually prioritized because a member requested this ticker, APLD.
Right.
So if you want prioritized deep dives on the companies you're watching, think about becoming a member of Stock Analytics AI. It's just Euro $4.99 a month. You give us a ticker. We aim to prioritize the analysis using the latest info.
You can find them on YouTube. Just search Stock Analytics AI.
And while you're there, please do subscribe to this channel. Hit that like button. It really helps us know you're finding this valuable and lets us keep making these deep dives for you.
Yeah, your support, it definitely makes a difference.
Okay, so we mentioned the big news and the risks. As we go through all this information, keep one question in your mind. What is the single biggest factor that will likely determine the future of Applied Digital? We'll reveal what the sources point to right at the very end. It's got to be more than just signing contracts.
Oh, much more. It's really about delivery.
Okay, let's unpack this. Chapter 1, Business Understanding. So, kicking off, what is Applied Digital Corporation? What exactly do they do?
Well, the sources say they're a technology firm. Their main thing is designing, building, and then operating these next-gen digital infrastructures, specifically for high-performance computing, HPC, and the AI industries.
Okay, so they're building the physical homes for all that AI computing power.
Basically, yeah. They're trying to build the foundation, the power, the space that this AI revolution needs to actually run. Think about training those huge AI models or complex simulations. That needs enormous compute power, and APLD wants to provide the data centers for it.
Got it. And they haven't always been just about AI, right? The sources talk about a big pivot.
That's right. APLD actually started out as Applied Blockchain. Their main business was hosting services for crypto mining. Yeah, but they saw this explosive demand for AI compute coming and, well, they pivoted hard, leveraging some of their existing infrastructure know-how.
So that pivot was a huge strategic move then.
Definitely. It moved them from, a pretty volatile, maybe more commoditized business like crypto hosting towards this potentially higher margin, more specialized AI HPC market. Required a big shift in their model and where they put their money.
Right. And you can still see bits of that transition in their recent results, can't you? Like in their Q3 fiscal 25 report.
You can. They still have that legacy data center hosting business,
Yeah.
the crypto focus, sites like Jamestown, Ellendale. In Q3, that brought in, what was it, $35.2 million?
Yeah, $35.2 million. But the sources pointed out it was actually down 7% year over year, facing competitive pressure there.
And that decline really shows the headwinds in that older business, doesn't it?
Yeah.
It kind of underlines why the pivot to AI HPC isn't just an option. It's pretty essential for their growth based on these numbers.
Okay. Then they had their cloud services business. This is where they offered GPU computing directly, right? For AI developers.
Exactly. Direct GPU access for AI and machine learning. Q3 revenue there was $17.8 million.
Which sounds pretty good, up 220% year over year. That's massive growth.
It is, but interestingly, it was actually down from the previous quarter, Q2. They said it was due to some technical issues when they were transitioning GPU capacity.
But even with that growth potential, they decided to sell it off.
Yeah, that's what's really telling. The sources say the board approved the plan to divest, basically sell this cloud services business back on April 10th, 2025.
Why do that if it was growing so fast?
Well, the thinking seems to be about streamlining, sharpening the focus squarely on the core HPC data center hosting business. It's kind of a move towards being more of a pure infrastructure provider, almost like a specialized real estate company for AI.
Okay, so getting out of offering the cloud service itself, just building the big facilities for others. Which brings us to their main focus now, the HPC hosting business. The sources call this the primary strategic focus and future growth engine.
Right. This is all about designing, building, operating those massive next-gen data centers specifically for these heavy HPC workloads.
And the crown jewel of this strategy seems to be their campus in Ellendale, North Dakota.
Absolutely. The sources describe Ellendale as having huge power potential, over a gigawatt. They've got their first 100-megawatt facility under construction there now, should be ready for service in the second half of 2025.
And part of that is specifically for a big tenant, CoreWeave, right?
Yeah.
Slated for Q4 2025.
That's the timeline, yeah. CoreWeave gets a piece of that first 100 milliW building by the end of this year.
And they're already negotiating for more capacity there, up to 400 milliW with hyperscalers. The CEO apparently thinks one customer might take that whole chunk.
It really highlights the scale they're targeting. I mean, building for companies needing that kind of power, it requires enormous capacity and super reliable infrastructure. That's the aim for Ellendale.
Okay, speaking of tenants and scale, let's get into the key strategic initiatives and partnerships. Because the absolute biggest news, the thing that moved the stock so much, announced June 2nd, 2025, the CoreWeave lease agreements.
Paramount. That's what the sources call it. And based on the details, it really is a game changer for them.
Like, what's the scope?
It covers about 250 megawatts of critical IT power at Ellendale. And the duration is long-term, around 15 years for each lease.
15 years. And the total projected revenue from just this one deal, the sources say $7 billion over the lifetime. $7 billion. That's staggering compared to their past revenue.
It's transformative, no question. That number alone gives them huge long-term revenue visibility. And the agreement also includes an option for CoreWeave to take another 150 megawatts.
Potentially 400 megawatts just with CoreWeave then.
Potentially, yeah.
But the timeline sounds incredibly tight. First 100 milliW building for CoreWeave by Q4 2025, end of this year, and a second building for the other 150 milliW by mid-2026.
Very tight. The sources emphasize this is a watershed moment. It validates their big pivot and significantly de-risks the revenue, if they can execute.
That if executed seems crucial.
Absolutely. And it also introduces a pretty significant customer concentration risk, doesn't it? I mean, based on these projections, their future is going to be highly, highly dependent on this one single tenant.
Yeah. If anything goes wrong with CoreWeave, that's a big problem for APLD.
A major impact, yeah.
Okay, beyond CoreWeave, they also secured a partnership with Macquarie Asset Management, or MM.
Right, MM, a huge global infrastructure investor. The sources say MM has the right to invest up to $5 billion to support up to 2 gigawatts of data center development by APLD.
$5 billion potential investment. That's serious capital access.
It's crucial and flexible. Building out gigawatts of data center capacity takes, well, eye-watering amounts of money. This partnership offers a potential path to scalable financing. Apparently, MM is also helping APLD in discussions with other potential customers. Adds credibility.
And there's bank financing, too. Sumitomo Mitsui Banking Corporation, SMBC.
Yes, for a $375 million debt deal, closed in February 2025. They used some of it to repay an older note and the rest to fund the initial construction at Ellendale.
Getting that kind of debt from a major international bank like SMBC, that's a pretty strong endorsement, isn't it?
It really is. Suggests the Ellendale plan passed some serious due diligence by the bank. And like Miram, SMBC is also apparently helping with customer discussions. So these partnerships show APLD can attract significant outside capital and validation, which is vital given how capital-intensive this build-out is.
Okay, so Chapter 2 then. Management evaluation. They've got the vision, the location, the anchor customer, the financing lined up. But who's actually leading this charge? Can the team pull it off?
Well, the sources focus quite a bit on the chairman and CEO, Wes Cummins. He's a co-founder, and he's widely credited with leading that big pivot and, crucially, securing these major deals. CoreWeave, MAM, SMBC.
And he has skin in the game, right? Significant ownership.
Yeah, around 10% beneficial ownership. That generally helps align his interests with shareholders.
And they've brought in new people recently?
They have. They mentioned the CFO, Seydal Momand, who joined in late 2024. And notably, a new COO, Laura Lautrello, appointed in January 2025. The sources suggest this hire was likely aimed at boosting their operational capabilities.
Okay, which leads to the question of strengths versus potential gaps in the management team.
Right. Based on the sources, their clear strength seems to be in deal-making and navigating capital markets. I mean, the evidence is right there with the CoreWeave, MA, and SMBC deals.
Makes sense.
But the potential gap, noted is maybe less proven depth in the very specific, large-scale, hands-on operational execution that's needed now.
Well,
Building out massive physical infrastructure like Ellendale, on time, on budget, that's a different skill set.
right. The classic challenge of transitioning from being great deal makers to being great builders and operators. And that new COO hire sounds like it's aimed squarely at plugging that potential gap.
That's exactly.
Yeah.
That seems to be the rationale. Now, their capital allocation strategy, well, it's what you'd expect, really. High growth, capital-intensive company building huge things. It's all about aggressive reinvestment. The sources are clear. No history of dividends, no share buybacks.
Every dollar goes back into building more data centers?
Pretty much. They rely heavily on external debt and equity financing. We mentioned the SMBC debt, $375, the potential MAM, $5 They also raised $150 in convertible preferred equity in April 2025. And their CapEx capital expenditures, it's been huge. Over $661 million in just the first 9 months of fiscal 25.
Wow.
So this strategy, it's appropriate for where they are, but it makes them super dependent on these future projects actually generating strong returns. They need that cash flow to service the growing debt and fund the next phase.
And the recent divestitures fit into that. Selling the cloud services business, the Garden City facility.
Yeah, those look like tactical moves. Sharpen the focus on the core HPC build-out, free up some capital, streamline things. Makes sense strategically.
How about corporate governance?
Board seems mostly independent, which is usually seen as good practice. Insider ownership is significant. We mentioned that 10-11.8% range collectively, including Cummins' stake. That alignment is generally positive.
And lots of big institutions on the stock, too.
Yeah, institutional ownership is high, around 62%. Sources name holders like Hood River, BlackRock, Vanguard, Oasis Management, Geode Capital, big names.
And then there's that NVIDIA stake.
Right. Worth mentioning again, NVIDIA, the AI chip giant, holding 3.43% as of March 2025.
What's the potential significance there? Is it just an investment or?
Well, it's hard to know for sure, but the sources speculate. It could be seen as a kind of strategic nod, an endorsement from a key player, or maybe it's about NVIDIA ensuring capacity access for its partners, like CoreWeave, who use their chips. Either way, it adds a layer of credibility in the market, doesn't it?
It does seem significant. Now, we do have to address some past issues and status based on the sources. There have been some governance concerns raised.
Yes, and actually, APLD themselves identified material weaknesses in internal controls back in November 2024.
What kind of weaknesses?
Things related to how they recorded financial data, user access controls on their systems, identifying related party transactions properly, and just the overall design of their internal control systems.
That sounds serious.
It is a significant risk. Now, they stated these weaknesses didn't result in any identified misstatements in their financial report so far, but it's definitely something that needs urgent fixing.
And there's a lawsuit.
A securities class action lawsuit, yeah. Filed back in August 2023. The allegations were about overstating profitability, misrepresenting their AI cloud claims at the time, and some issues around board independence.
What's the status of that now?
The sources we reviewed as of early June 2025 didn't have recent updates. So it seems to still be out there, a potential legal overhang and uncertainty for the company.
Okay. And there were also those critical short seller reports from mid-2023, Wolfpack Research, the Bear Cave.
Right. The sources mentioned those. They came out in July 2023, called APLD, a stock promotion, questioned customer viability. They specifically mentioned Stability AI back then, questioned GPU orders, infrastructure readiness, board competence, potential conflicts involving B. Riley.
And those reports hit the stock price at the time.
They certainly did. Now, how has APLD responded? The sources don't detail specific public rebuttals point by point, but they frame these recent massive deals, CoreWeave, MEM, SMBC, as, well, tangible evidence of progress, real third-party validation that implicitly serves to counter some of those earlier short seller claims about viability and legitimacy.
That's a fair point. Signing a $7 billion deal with a major player like CoreWeave, getting backing from M and SMBC, it's harder to dismiss that as just promotion, isn't it?
It definitely provides a level of validation that wasn't there a year ago. Oh, and finally on governance. The sources briefly mentioned potential conflicts of interest, some overlaps between APLD execs Cummins, Moman, Kraxberger, and an entity called 272 Capital LP, just notes it's an area requiring scrutiny for related party transactions.
Okay, quite a history there. Let's move to Chapter 3, Financial Health. Let's dive into the actual money story. What does it look like historically and now?
Well, APLD's financial history, based on these sources, it's really a tale of two things. Very rapid revenue growth, but alongside that, persistent unprofitability.
Fast growth on top, deep red on the bottom. Sources show revenue jumping from, what, $8.5 million in fiscal 22, way up to $165.6 million in fiscal 24.
Yeah, massive jump. And trailing 12-month revenue as of February 2025 was $221.2 million. But their latest quarter, Q3 fiscal 25 revenue of $52.9 million, that actually missed analyst consensus expectations.
Missed the target and the losses.
Consistent quarter after quarter. Q3 fiscal 25, the GAAP net loss was $36.1 million, or 0.68 cents per share. They reported an adjusted net loss of $17.8 million, which beat consensus, but still a loss.
Then Q2 was even worse.
Q2 had a much larger reported net loss, yeah, but that was heavily impacted by some big non-cash charges. Across the last 12 months, TTM EPS is definitely negative, somewhere between negative $1.09 and negative for 46 cents per share, depending on the exact period.
So losing quite a bit of money relative to their sales. How do the margins look?
Margins are also flagged as a concern in the sources. Gross margins are, well, low, and they fluctuate quite a bit, implied around 7.2% in Q3. That's way lower than the reported industry average for established data center players, which is often over 30%. And operating and net margins are consistently negative. Shows that even after the direct costs of revenue, their operating expenses eat up more than their sales.
But what about adjusted EBITDA? That's been positive sometimes, right? Like $10 million in Q3, though that missed estimates too. Does that mean they're generating some cash operationally?
It suggests some operational cash generation before you factor in big items like interest payments on their debt, taxes, depreciation, amortization. So before all those other significant costs. The GAAP net loss figures, though, they show the full picture, including those costs. And that picture is consistently unprofitable operations.
Okay, so money going out faster than it's coming in from the core business. How's their overall financial health looking right now, then, given all this?
Let's break it down based on the sources. On liquidity, their ability to meet short-term obligations, the current ratio actually improved to about 1.32 as of February 2025. That's generally positive, means current assets cover current liabilities. Working capital is positive too, around $66.6 million, and they had cash, about $68.7 million, plus another $185.5 million in restricted cash in February.
Okay, that sounds better, but,
and this is critical from the sources, they are heavily reliant on external financing. Why? Because of deeply negative free cash flow and those massive CapEx needs for building Ellendale.
Right. The business itself isn't generating enough cash to fund the build-out.
Exactly. So that improvement in reported liquidity, it's largely thanks to the cash coming in from those recent financing deals, the SMBC debt, the preferred equity raise, not from operations.
Got it. And solvency, their ability to meet long-term debt obligations. How much debt are we talking?
Total debt was $689.1 million as of February 2025. Debt-to-equity ratio around 2.2, which is pretty significant leverage. And traditional interest coverage ratios look unfavorable because, well, they're operating at a loss. Interest expense alone was $8.9 million in Q3.
So what does that mean for their ability to actually pay back all that debt?
The sources really emphasize this. Servicing that substantial debt burden is entirely contingent on these new HPC facilities, especially Ellendale, becoming operational, hitting profitability targets, and generating enough cash flow. It's a high-stakes bet on future success.
Which is exactly the bet they're making with CoreWeave and the whole pivot.
Precisely. The profitability trends just reiterate this ongoing unprofitability. The whole strategic shift is designed to reverse that trend. Success in the HPC hosting segment, achieving decent margins there, is absolutely essential for their long-term financial future and ability to handle the debt.
And no surprise for a company pouring every penny into growth, the sources note no dividend policy. No dividends, no share buybacks.
Nope. Consistent with their strategy. All about reinvesting back into the business. Which means, for investors, any potential return is purely riding on the stock price going up, if the strategy works out.
Okay, let's shift gears then. Chapter 4. Market sentiment. How is the market reacting to this whole story, especially the recent big news?
Oh, the reaction has been dramatic, to say the least. The sources detail the recent stock performance. On June 2nd, 2025, the day the CoreWeave deal was fully announced, the stock closed at $10.14. That was a surge of 48.46% in one day.
Wow, nearly 50% in a single session. That shows just how enthusiastically the market greeted that CoreWeave news and the $7 billion potential revenue figure.
Absolutely. Signifies a major positive shift in market perception, at least initially. And the trading volume that day was extreme, almost 239 million shares traded. compared to an average around 32 million. Huge activity.
Okay. And based on that June 2nd close, their market cap was around $2.28 billion.
Roughly, yeah. And the sources note the stock's high beta, around 6.09, which just confirms it's highly volatile. Its price tends to swing much more dramatically than the overall market.
High risk, high potential volatility. What are the professional analysts saying? The analyst outlook.
The sources report it's largely positive. The consensus among analysts covering APLD is overwhelmingly buy or strong buy.
So Wall Street seems generally bullish on the potential here. Price targets.
The average 12-month price target range given in the sources is somewhere between $11.36 and $12.81. But, and this is really important, there's a very wide dispersion in those individual targets. The full range goes from a low of $7 all the way up to $18 or even $20.
That wide range tells you something, doesn't it? Even the bullish analysts have pretty different views on how high it could go, or maybe how quickly. Lots of uncertainty still baked in.
Exactly. Despite the overall bullish consensus, there's still significant disagreement on the specifics. And the sources do mention several analysts raising their targets after the CoreWeave deal came out. H.C. Wainwright, GMP Securities, Craig Hallam, Needham.
Okay. How about valuation multiples? How do you value a company like this?
Well, the sources point out traditional metrics like PE, price to earnings, aren't very helpful right now.
Because they don't have earnings, right? They have losses.
Exactly. Negative PE isn't meaningful. So you look at things like price to sales. Based on that $2.28 billion market cap and $221 million TTM revenue, the PS ratio is around 10.3x.
Is that high?
Yeah, that's generally considered a high multiple. It reflects that the current stock price is baking in very high expectations for future growth, not based on current financial performance. Similarly, the EV-adjusted EBITDA multiple is also noted as high, though forward estimates might look lower if you assume the CoreWeave revenue ramps up as planned. These are typical multiples for growth stocks where the bet is on future potential.
And what about ROIC analysis? Return on invested capital, basically, are they making money on the money they invest?
This is really key. The sources explain that historically APLD's ROIC has been negative. Figures like negative 16% are cited, or return on assets, ROA, of negative 26.7%.
So historically, for every dollar they've put into the business, they've actually lost money.
Precisely. It indicates past value destruction. And their WACC, their weighted average cost of capital, basically what it costs them to raise funds, is likely pretty high, given the high beta in the debt. So for APLD to actually create value for shareholders going forward, they must generate a future ROIC from projects like Ellendale that significantly beats that high cost of capital.
That's the whole point of the CoreWeave deal, right? To generate those high returns.
That's the hope in the plan. But it's not yet proven in operation. It's still future potential.
Okay, let's quickly touch on Chapter 5, ownership structure. Who actually owns the company?
All right, we touched on this briefly under management. Insider ownership is significant, around 11.8% collectively. CEO Wes Cummins holds about 10% himself. Generally seen as positive alignment, skin in the game.
And institutional ownership.
Also substantial, about 62%. Big funds. The sources list the largest holders mentioned. Hood River, BlackRock, Vanguard, Oasis Management, Geode Capital Management, major players.
And that NVIDIA stake again, 3.43% as of March 2025.
Yeah, worth reemphasizing its potential strategic importance. Endorsement. Access. Still speculative, but it definitely adds an interesting dimension to the ownership structure within the AI ecosystem.
All right, we've covered the business, the management, the financials, the market view. Now for the really critical part, Chapter 6, risk assessment. What are the big dangers lurking here, according to the sources?
The sources outline several major risks. Probably the biggest one, tied directly to that huge CoreWeave deal, is execution risk.
Training.
Meaning the massive challenge of actually successfully completing and operating those Ellendale facilities on time within budget, specifically hitting those tight CoreWeave deadlines, Q4 2025, mid-2026, and scaling up their operational management for these complex HPC deployments, which is very different from their old crypto hosting business. That's a huge hurdle.
That makes total sense. Getting the contract signed is one thing, fantastic even, but actually building a multi-million square foot, power-hungry data center, getting all the complex cooling, networking, everything running reliably, and doing it on that schedule, that's a monumental operational task.
Absolutely. Then there's customer concentration and contractual risks. Post-CoreWeave, APLD becomes overwhelmingly reliant on this single tenant. If anything happens to CoreWeave's business, or if there's some kind of contract dispute down the line, it could disproportionately hammer APLD.
Even with a 15-year contract, having so many eggs in one basket is a risk.
Definitely. Plus, they still have renewal risk on those smaller legacy crypto contracts too.
Okay, what else?
Financial risks. We've covered these, but worth summarizing. That history of net losses, negative free cash flow, the fundamental uncertainty about achieving sustained profitability, the substantial debt load, $689.01, the ongoing need for more capital to fund future growth, the reliance on financing for liquidity, and the fact that servicing all that debt depends entirely on future profits from these new, still unproven HPC facilities.
It's definitely a high-wire act financially.
It is. Then, competitive pressures and technological change. The data center market is hyper-competitive. You've got huge, established REITs, other specialized providers, plus the hyperscalers like Google, Amazon, Microsoft, building their own massive capacity.
Right, tough competition.
And technology moves so fast. GPUs, cooling tech, networking, they'll need continuous, significant investment just to keep their facilities cutting edge and ensure they don't become obsolete quickly, which of course costs more money, adds to CapEx.
Okay. Any other major risks?
Yes. Regulatory and geopolitical risks. And the authors get quite specific here about the impact of U.S. 2025 tariffs. This sounds complex.
Okay, let's try to unpack this tariff situation. The sources mention new tariffs coming in a 10% blanket tariff, plus potentially higher reciprocal ones on goods from places like China, Mexico, Canada.
Right. And the estimates cited suggest this could add another 1.5% to 2.5% to overall construction costs on top of other inflation, potentially leading to a total cost increase forecast of around 5.8% to 6.8% for 2025 construction projects.
How does that hit data center construction specifically?
Well, it increases costs for key materials, steel, aluminum, cement, lumber. One analysis mentioned in the sources suggests a mid to high single-digit percentage increase specifically for data center construction materials.
Okay, materials cost more. What about the actual tech hardware? The GPUs, the servers, the networking gear?
This is where it gets really interesting and, honestly, a bit murky based on the source material.
Yeah.
It seems semiconductor dies themselves are largely exempt. But GPUs and the equipment to make them were not initially on the exemption list. Automatic data processing machines, which could include servers, also aren't automatically exempt.
So the core AI tech might get hit.
Potentially. However, there's a crucial detail. A temporary USTR exemption specifically for China-sourced GPUs and motherboards that runs until August 31st, 2025.
So a temporary reprieve for some key components sourced from China. But the risk comes back after August.
Exactly. Short-term relief, but long-term uncertainty remains. And like you said, there seems to be conflicting info. One part suggests fully assembled GPU servers might be largely exempted, maybe due to assembly elsewhere like Mexico, but another part says GPUs themselves aren't broadly exempt. This inconsistency highlights a significant area of risk and confusion.
Definitely unclear. What about networking?
Optical modules, crucial for high-speed networking in these data centers, are expected to see significant price increases, maybe 25–40%, due to tariffs.
Okay, so how does all this tariff uncertainty specifically impact APLD's big plans at Ellendale?
It means potentially higher CapEx for the build-out, higher costs for materials, maybe hardware depending on sourcing and exemptions. It adds significant cost uncertainty. This could cause project delays or put direct pressure on their projected profitability and the returns on the project unless they can successfully pass those higher costs on to CoreWeave or other future customers, which isn't always easy or guaranteed. It's another layer of material risk on top of an already complex execution challenge.
Yeah, that cost uncertainty definitely doesn't help when you're trying to execute on time and budget. What other risks?
Governance and management risks. This circles back to points we discussed earlier. The need to successfully fix those internal control weaknesses they found. The uncertainty around the outcome of that securities lawsuit. Any lingering perception issues from the short seller reports. And the need for scrutiny on those potential conflicts of interest.
Got it. And risks related to their ongoing strategic shifts, like selling the cloud business.
Yes, there's execution risk there too. Can they sell it successfully, get a good price, ensure a smooth transition that doesn't disrupt the main business? And the sources also mention a potential future move to become a REIT, a real estate investment trust. That kind of transition carries its own set of significant challenges and uncertainties.
Okay. And finally, market risks.
We mentioned the high volatility, that beta around 6.09. But the number that really jumps out from the sources, indicating huge market skepticism, is the exceptionally high short interest.
Ah, yes, the short interest. Why are so many sophisticated investors betting against this company, especially right after they announced that huge CoreWeave deal?
The sources state the short interest was a massive 35.68% of the float as of early June 2025.
35%. That is incredibly high. What does that signify?
It signifies a very deep division in the market about APLD's prospects. A substantial chunk of sophisticated money believes the company will struggle significantly. Maybe they doubt the execution ability, maybe they're focused on the debt burden, the history of losses, the governance issues. Whatever the reason, they are betting heavily against the stock. This makes APLD a classic battleground stock.
Meaning it could swing wildly.
Exactly. Highly susceptible to sharp moves. Either a massive short squeeze upwards if APLD starts hitting its milestones and proving the doubters wrong, or significant further declines if they stumble on execution or face other setbacks.
Wow. So high risk, potentially high reward, and a lot of smart people betting on completely opposite outcomes. That really sums up the complexity here.
It really does. It's an intense situation.
Okay, Chapter 7, Conclusion and Hook Reveal. Let's try to wrap this up and revisit that question from the start. Summing up the investment case, based only on the source material we've deep dived into.
Okay. APLD is making an aggressive, ambitious pivot into the high-growth AI/HPC data center market. That market has explosive demand. The CoreWeave deal is a massive win, gives them huge revenue visibility, critical validation, and the partnerships with MM and SMBC provide crucial access to the enormous capital they need.
BUT, and it's a big but. The company has a clear history of significant losses, negative free cash flow. They've piled on substantial debt. They face enormous, complex execution risks building out Ellendale on time, on budget. It's a hyper-competitive market, technology changes fast, and those tariff uncertainties add cost risk. Plus, you have the lingering governance questions, the lawsuit overhang.
And that incredibly high short interest, signaling deep skepticism from a large part of the market.
Right. So, given all that, what was the final recommendation presented in the source material?
The recommendation cited was a speculative buy as of June 3rd, 2025.
Speculative buy. Why speculative? What makes it speculative?
Because, as the sources imply pretty strongly, it's fundamentally a bet on future unproven execution. It's a bet on them successfully delivering on these ambitious build-out plans and actually capturing that market opportunity. It's not a bet based on their historical financial strength or any wide competitive moat they currently possess. It requires a high tolerance for risk.
And on valuation, the sources basically say traditional methods are tough because there are no profits. You really need a substantial margin of safety in your own analysis, given all those risks and the heavy reliance on future performance turning things around.
Yeah, it really boils down to whether they can translate the promise of CoreWeave and the capital they've raised into profitable, functioning reality.
Which brings us right back to the question we posed at the very start. Based on this deep dive into all these sources, what is the single biggest factor that will determine the future of Applied Digital Corporation?
Based on everything we've reviewed in the material, the single biggest factor seems clear. It's successful and profitable operational execution of the Ellendale HPC campus and securing further long-term AI HPC leases.
So it's not just about signing the CoreWeave deal, as huge as that was. It's about actually building and then running those massive data centers profitably, hitting those deadlines, and then filling up the rest of that gigawatt-plus capacity they're planning at Ellendale.
Precisely. It boils down to turning that $7 billion potential revenue and the access to capital into real functioning profitable data centers that generate sustainable cash flow. That cash flow is absolutely vital. They needed to service that growing debt pile, to fund future expansion, and ultimately to create value for shareholders.
Yeah.
The deals and the financing, they're crucial enablers, yes, but the execution on the ground, that's the ultimate high-stakes test.
Okay, so what does this all mean for you, the listener, as you think about APLD? Here's a final provocative thought to leave you with. Given APLD's history of losses, the sheer scale and complexity of building Ellendale, and those potential operational experience gaps noted, can the team that proved so effective at deal-making really deliver on the incredibly complex operational challenge of building and running a gigawatt-scale AI campus on such a tight timeline?
And with that exceptionally high short interest, so many sophisticated investors actively betting against them are the bears seeing fundamental flaws, execution risks, financial strains that the bulls, perhaps dazzled by the market opportunity, are missing.
Or is this company potentially set up for a dramatic short squeeze if they do manage to hit those critical operational milestones at Ellendale and start proving the skeptics wrong?
It feels like a situation with potentially binary outcomes. The path forward is clearly fraught with significant risk and uncertainty, even with that enormous market potential beckoning.
If you found this deep dive valuable and you want more analysis like this, please do subscribe to the Stock Analytics AI YouTube channel. And remember, you can become a member for just Euro 4.99 a month, give us a ticker, and get prioritized deep dives like this one. And now, the essential research and AI disclaimer. Please remember, this deep dive is for informational purposes only. It is absolutely not investment advice. Investing in securities involves significant risks, including the very real possibility of losing your principal investment.
This analysis is based solely on the source material provided to us as of June 3, 2025. The author of the source material stated they held no position in APLD stock at the time of writing.
Any forward-looking statements discussed here are inherently uncertain. Things might not turn out as expected. Data currency can also vary between the different sources we used. Always conduct your own thorough due diligence, and please consult with a qualified financial advisor before making any investment decisions.